Hello and welcome to the Mertz Taggart first quarter 2023 home-based care M&A report. My name is Corey Mertz. I'm a managing partner here at Mertz Taggart. We are a healthcare services, mergers and acquisitions firm that focuses really in two verticals within healthcare services. First is home-based care, which we'll talk about today, and then the second is behavioral healthcare. So let's get into it. I'm going to start off by just talking about the market overview, what's happening out there, just in terms of transaction volume. Spoiler alert here, transaction volume is down pretty significantly. And then we'll go into the activity by service line, home health, home care, hospice. Then we're going to get into the deal of the quarter, which of course is the Optum acquisition, long-awaited Optum acquisition of LHC Group. They finally closed on that in February. And then we're going to get into just a quick summary of what's happening in the marketplace today. Okay, as I mentioned before, transaction volume is down significantly. We had 14 transactions total reported in the first quarter. That's down from really any other period that we've tracked going back to 2014. And we'll get into the why here in just a couple of minutes. But let's get into the activity by service line. First is Medicare certified home health, very small numbers there, 3 deals reported. We saw at least, right around 10 deals reported a quarter last year. That was even in light of the proposed rule, which, spooked a lot of folks. But that's translated into even fewer transactions in the first quarter. Led by the Optum LHC Group deal that included all 3 verticals, really home health, home care, hospice. And then another notable transaction. This was a Mertz Taggart client. So we represented the client in this transaction, and that was Capital Health Home Care sale to Amedisys in West Virginia. Bruce Vanderlaan led that transaction for Mertz Taggart. Okay, hospice transactions, equally few, or almost equally few. We saw 5 deals. Again, the lowest that we've seen, really going back to 2014. Most notable would be, I would say, of course, we've talked about Optum's acquisition of LHC Group, but another notable transaction is Humana's, actually I should say Gentiva, which is Humana's Hospice and Home Care division. Along with their financial partner CDR, they acquired ProMedica. They're ProMedica's Heartland Hospice division for $710 million. So that was a sizable transaction. I wish I had more details to share with you, but I don't. Okay, let's get into home care. Home care held its own, at least relative to the other verticals, and really even relative to fewer or the most recent periods. And there's a couple of reasons for that. But to get into the details, and it's really led by the increased demand for government-backed non-medical home care. And I'm really talking about the Medicaid providers out there, home and community-based services, and VA providers out there. That's where the demand seems to be on the home care space more than anything at this point in time. Some notable transactions. We'll start off with the Mertz Taggart transaction. Our client, Home Sweet Home in home care, based in Michigan. They sold to PurposeCare. PurposeCare is owned by Lorient Capital, and they have a strategy of building a Midwestern-based, dual-eligible home care, home health provider. Help at Home was very active. Help at Home's backed by the Vistria Group. They did 2 acquisitions, or at least announced 2 acquisitions. One was Prosper Home Care, based in Georgia. And then the other one, which was a pretty sizable transaction, was Open Systems Healthcare, based in Pennsylvania. And then another notable transaction, Amedisys sold its non-medical personal care division to Houseworks. Now, it's an interesting story there. Houseworks is owned by Intandem Capital. Intandem acquired Houseworks simultaneous with this transaction, or almost simultaneous. Houseworks was headed up by Mike Trigilio, Mike actually started what is now this personal care division, led the personal care division for Amedisys, left Amedisys a while back, and is now back leading the charge here on Houseworks personal care division. So it's an interesting story. Okay, let's get into the transaction of the quarter. Of course, that was Optum's acquisition of LHC Group. Finally closed in February after about 11 months of regulatory clearance. Some of the key points of that transaction, it was, they sold for $170 a share or $5.4 billion. Now, the total enterprise value, the way an investment banker will look at this, total enterprise value is actually closer to $6.1 billion if you include the debt that Optum acquired as part of the deal. Adjusted EBITDA, closest that we could tell, if you look at LHC Group's third quarter 22 filing, which was the most recent, they were tracking to right around $240 million as of the closing. So if you do the math there, the transaction sold for right around 25 times, which is pretty healthy multiple. And again, I think that just shows Optum's interest and value in the home-based care market, specifically the LHC Group. It certainly advances the payers, and Humana really started this, or has led the most recent wave evolution towards being payviders. Again, these payers are really starting to see the value of providing home-based care in lieu of facility-based care. So let's talk about demand. Demand remains historically high, despite the interest rates issues and the uncertainty that we've seen out there economically. Bank failures, debt is getting tighter, and it's become much more expensive. And if you look at asset valuation theory, it will tell you that as interest rates go up, valuations, i.e., stock prices of companies, will tend to come down and lead to lower valuations. And the reason for that, a couple of reasons for that. Number one, higher interest rates means the cost of capital is more expensive. These buyers rely on debt to acquire these companies, and their cost of capital has gone up. So borrowing costs have gone up significantly. From an investor perspective, if you just look at the equities markets, in some cases there are other alternative investments out there that may look more attractive than the equities markets. For example, savings. We're seeing some money markets out there that are paying, I think, close to 5%. That can look pretty attractive as a very safe alternative for investors right now. So as interest rates go up, values come down. But you note my little footnote here, that's assuming everything stays constant, right? And that's not the case here. So let's talk about supply and demand. And we'll start with really the supply, right? If you look at the transaction volume over the last few years, this was really driven by a supply. Owners headed for the exits in 2020 and 2021. It's driven by two things. We've talked about this ad nauseum. The first was the capital gains tax rate, or the threat of the capital gains tax rate going up from 20% to 40%. That would mean that would-be sellers might have to work a couple more years to ultimately get what they would have originally received in a transaction after taxes. So if you look back to 2014, 2015, all the way through 2019, we averaged right around 110, 120 transactions per year. I would call that normal. If you look at 2020 and 2021, we averaged 166 transactions in those 2 years, really starting at the end of 2020. So what that created was basically a surplus, right, of 46 times 2. So 92 transactions, extra transactions happened in 2020 and 2021. That threat of the capital gains tax rate has since subsided. Not suggesting it won't come back again, but that threat has subsided. And those sellers that would have sold this year or last year sold in 2020 and 2021. So there's fewer opportunities out there in the marketplace. So what we're starting to see there is really a reversion to the mean. Okay, so let's talk about demand. Why is demand so high? Well, number one, private equity. So we talked about interest rates. Interest rates go up, values come down. That really applies to the high end of the market, right? The publicly traded stocks, we've seen it in the equities market. But it also applies to those companies that are selling at the high end of the market. So let's just say those companies that would have sold for 100 million up to say 2 or 3 billion. If those companies would have sold a year or two ago, they may have commanded a multiple in the high teens or even low 20s. Those multiples have come down. So as a result of that, private equity, because they can't exit for the multiples that they expected to, they're doubling down on acquisitions, really doing add-on acquisitions. And they have significant dry powder to do this. So demand has increased as a result of fewer private equity-backed exits. Now, there's some exceptions out there, right? But we're going to see fewer of them over the next 12 months. And of course, the value-based care disruption. We've seen these payers, Optum paying 25 times for LHC Group. Private equity bets that this trend will continue. The payers, the public companies will continue to see the significant value that the care at home providers offer. Now, I feel compelled to balance this a little bit by saying buyers have become more disciplined. For example, they're looking at fewer targets. They've really honed in on what they'll consider in terms of size, geography, and payer mix. Whereas perhaps some buyers would have considered 20 different states. Now they're really focusing in on 5. A company we may have taken to market 2 years ago that would have received 20 indications of interest. We may only receive 12 to 15 now. Buyers are considering fewer opportunities. They're much more honed in on what they'll consider. They're less inclined to acquire unprofitable. Not saying that there aren't buyers out there for those opportunities. There certainly are. But most of those buyers right now, those private equity buyers that are doubling down on acquisitions, they're looking for EBITDA. They're looking for cash flow. They're less interested in turnaround acquisitions and paying for turnaround acquisitions. And I'm really talking about pro forma adjustments. We've seen this historically, especially in the hospice side, where buyers would look at, okay, under our watch, this hospice within the next 4 or 5 quarters should generate X EBITDA. Now they're really looking at the historical period and basing their values more based on the historical period. And that could be trailing 12 months or even a shorter period than that. But much less likely to just take a lot of the pro forma adjustments that we put out there historically. And then finally, we're starting to see a more comprehensive due diligence process, especially on the quality of earnings. A quality of earnings miss a couple of years ago, a small miss may have gotten swept under the rug. Now buyers may be more inclined to suggest, the cash flow isn't what we thought it was. We're going to have to come back and talk about value again. So we're starting to see a little bit more of that as well, tightening up the quality of earnings due diligence piece as well. Thank you for your time. If you have any questions, feel free to email me at Corey@mertztaggart.com, and I'll look forward to talking with you again next quarter.